Alright, in this video we'll go over the constant growth model, otherwise known as the Gordon's growth model, and the zero growth model for valuing shares. I'll also explain what a perpetuity is and how it relates to these models, and work through a two-part example showing how these models can be used to value a share. And I'll include some timestamps in the comment section so you can skip ahead if you're just looking for the example, if that's what you're here for. So what are these formulas about? Well, the constant growth model and the zero growth model are two ways of valuing a share or an asset based purely on the dividend or constant cash flow stream that it generates and the return that you require from that asset. And the only difference between these two formulas is this value here, G, that represents the rate at which the dividend stream will increase or grow given as a percentage. These formulas are essentially present value calculations of a perpetuity. And a perpetuity is a name for a cash flow stream or annuity that continues forever. So these models take your required rate of return and use it to discount the never-ending cash flow stream to a present value in today's dollars. It's important to understand that as your required return increases, the present value decreases. This is because if you need a higher return overall, you need to pay less for the asset now, as the cash flow is a set amount and will become less value over time due to the time value of money. And vice versa, if you only require a low return, then the present value will be higher, as you can afford to pay a higher price now if you don't require such a high return. So when do you want to use these models? Well, you want to use these formulas when you need to give a present value to a share paying a dividend at a fixed amount forever. And when that dividend is forecast to grow at a steady rate, say 5% per annum, year after year, at the same rate, the constant growth model can be used. Otherwise, if there's no growth, then you're going to be using the zero growth model. Now, the two formulas are essentially the same, with the only difference being the presence of a growth rate variable and it being subtracted from the required rate of return in the Gordon's growth model. Okay, so let's jump into an example. So here we have the formulas. On the left, we have the Gordon's growth model, or the constant growth model, and on the right, we have the zero growth model. And you can see the only difference here is the subtraction of the G variable in the constant growth model. So the variables that we have here are P0 representing the present value, D1 represents the dividend or the constant cash flow. Important to note that this is worked out to a yearly amount. We have R, the required rate of return, and G, our growth rate. And here's our problem. So what value do you give to a security you are purchasing today, which pays a regular quarterly dividend of $2.50 if you require a return of 9% per annum? In part A, we're going to work this out with zero growth. In part B, we'll work it out with growth at a steady rate of 4% per annum starting next year and continuing forever. Okay, let's start by identifying the variables that we are going to use in the formulas within this problem. So what's our dividend? This is 2.5. However, this is given as quarterly, so we need to multiply that by 4 because we need the annual amount. So $10 per year in year 1. Our required rate of return, R, is 9% or 0.09, and the growth rate, which we'll use for part B, is 4% or 0.04. So let's go ahead and write these formulas out with the variables plugged in, and these are pretty basic. So the zero growth model is simply going to be 10 divided by 0.09. And our constant growth model is 10 divided by 0.09 less 0.04, so 0.05. Okay, so let's look at how we're going to plug these into the calculator and solve for part A first. So starting with an orange function in clear to clear all, and now we simply have 10 divided by 0.09 to give us 111.11, and that is our result for part A. Now for part B, we're starting again with an orange in clear all, and again inputting D1 as 10 and hitting divide. Now the denominator here is simple, however let's look at how to solve this within the calculator by performing the subtraction within brackets. So we've already hit divide, now hit the orange function button and RM to open up the bracket, followed by our 0.09 take 0.04, and the orange function button again, and M plus to close the bracket, and this gives us our 0.05. Now go ahead and hit equals to finish the calculation and give us our answer of 10 divided by 0.05 equal to $200. So this example is showing us that with an asset that's paying us the same dividend initially, if we require a 9% return and that dividend has no growth, we can pay $111.11 and achieve our 9% required rate of return. And if that same dividend were instead growing at a rate of 5% per year, so dividends in year 2 would be 5% more than dividends in year 1, we could pay $200 and still achieve our 9% return due to the increased dividend amount that would occur in year 2 and beyond. So what is important to remember about this concept? Well, a key point to remember is that with the constant growth model, your required rate of return must exceed the growth rate. So the required rate of return must be more than the growth rate. Otherwise, the value of the share will technically be infinite, as it will be outgrowing any rate of return, and it will never equate back to a present value. Another important thing to understand about this concept, and this is a question I asked myself when first looking at perpetuities, is how can something that generates cash forever and grows at a constant rate be equated back to a single figure as its value? Well, this is because of the required rate of return and the time value of money, and the fact that $1 today is worth more than $1 tomorrow because of its earnings potential. So assuming that our growth rate is less than the required rate of return, in X amount of years, that dividend of $2.50 or whatever it grows to will eventually be worth practically nothing in today's dollars, which allows us to put a cap and a present value on that dividend stream. So that's the end of the video. If you'd like to see more valuation methods with examples and other functions of this calculator, check out my channel. Feel free to like this video if it was helpful, or drop a comment with suggestions on how I can improve or questions. And also feel free to subscribe for easy access to more content showcasing the HP10bII Plus calculator. Thanks for watching.